Every single day, trillions of dollars move through the global economy, and most people have absolutely no idea how to read the documents that track it all. Today, that changes for you. Welcome back. In the next 10 minutes, you are going to understand exactly what financial statements are, why they exist, who uses them, and how the three main statements connect together like pieces of a puzzle. Whether you are a student, a small business owner, or just someone who wants to make smarter financial decisions, this video is going to give you a foundation that most adults never get. Let's dive in. Section 1. What are financial statements and why do they exist? Imagine you lend your friend $500 to start a small business selling handmade candles. A few months later, you want to know, is the business doing well? Did your friend make any money? Can they pay you back? You cannot just guess. You need information. Reliable, organized, honest information. That is exactly why financial statements exist. They are formal records that summarize the financial activities of a business over a specific period of time. Think of them as a report card. But instead of grades in math and science, you get numbers that tell you whether a business is healthy, growing, or struggling. Every business, from a tiny coffee shop to a massive corporation like Apple or Amazon, prepares financial statements. In fact, publicly traded companies are legally required to publish them, so that investors and the public can see what is really going on inside the business. Financial statements are not just for accountants. They are tools for decision-making. Managers use them to plan ahead. Investors use them to decide where to put their money. Banks use them to decide whether to approve a loan. Even employees sometimes use them to understand whether their company is stable. Now, here is something interesting. There are actually three main financial statements, and each one tells a completely different story. Want to know what those three stories are? Coming up next. Section 2, the income statement. Did the business make money? The first financial statement is called the income statement, and it answers one simple but powerful question. Did the business make a profit or a loss during a specific time period? Here is how it works. A business earns money by selling products or services. That money is called revenue. But to run the business, there are also costs: paying employees, buying materials, covering rent, running advertisements. Those are called expenses. When you subtract the expenses from the revenue, you get either a profit or a loss. Accountants call that final number net income. So if a bakery earned $80,000 selling cakes and bread last year, but spent $60,000 on ingredients, staff, and rent, their net income would be $20,000. Simple, right? The income statement covers a specific period, usually a month, a quarter, or a full year. It does not show you what the business owns or owes. It only shows performance over time. Think of it like a scoreboard at the end of a game. It tells you the final result, but not everything that happened along the way. And that raises a question. If the income statement only shows profit and loss, where do you go to find out what a business actually owns and what it owes? That is exactly what the next statement reveals. Section 3, the balance sheet. What does the business own and owe? The second financial statement is called the balance sheet, and it gives you a snapshot of the business at one specific moment in time. Think of it like a photograph. The income statement is a movie. It shows you what happened over a period. The balance sheet is a photo. It shows you exactly where things stand on one particular date. The balance sheet has three parts. The first is assets, everything the business owns. Cash in the bank, inventory, equipment, buildings, money that customers owe the business. All of that counts as an asset. The second part is liabilities, everything the business owes to others. Loans from the bank, unpaid bills, money owed to suppliers. These are the business's debts. The third part is called equity, sometimes called owner's equity or shareholder's equity. This is what is left over for the owners after you subtract the liabilities from the assets. It represents the true value that belongs to the people who own the business. Here is the magic formula behind the balance sheet, and this is one of the most important equations in all of accounting. Assets equal liabilities plus equity. Always, without exception. That is why it is called a balance sheet. Both sides must always balance perfectly. So now you know what a business earns and what it owns. But there is one more critical question. Is the business actually generating real cash? Because profit on paper and cash in the bank are not always the same thing. Let's look at the third statement. Section 4, the statement of cash flows. Where did the money actually go? Here's a surprising truth. A business can show a profit on its income statement and still run out of cash. How? Because revenue is sometimes recorded before the cash is actually received. A company might sell products on credit, meaning customers have not paid yet. On paper, it looks great. In reality, there is no money in the account to pay the electric bill. That is why we have the statement of cash flows. This statement tracks the actual movement of cash in and out of the business during a period. It is broken into 3 sections. Operating activities covers cash generated from the day-to-day business, selling products, paying suppliers, paying employees. Investing activities covers cash used to buy or sell long-term assets, like equipment or buildings. Financing activities covers cash from borrowing money, repaying loans, or paying dividends to shareholders. Together, these 3 sections show whether the business is generating enough real cash to survive and grow. Many financial analysts consider the cash flow statement the most honest of the 3 statements, because cash is very difficult to manipulate. But none of these 3 statements exist in isolation. They are deeply connected. So how exactly do they link together? Section 5. How the 3 statements connect. Think of the 3 financial statements as a system, not separate documents. They feed into each other in a very specific way. It starts with the income statement. The net income calculated there flows directly into the equity section of the balance sheet. If the business earned a profit, equity goes up. If it took a loss, equity goes down. Then the cash flow statement starts with that same net income figure and adjusts it to show how much actual cash moved during the period. The ending cash balance on the cash flow statement matches exactly the cash figure listed in the assets section of the balance sheet. Everything ties together. Every number has a home and another statement. That is the elegance of accounting. It is a complete, self-checking system designed to give an accurate picture of business reality. When you understand how to read these 3 documents together, you can look at any business in the world and understand its financial story, whether it is thriving, surviving, or heading for trouble. Closing and call to action. You just covered the foundation of financial accounting, what financial statements are, why they matter, how the income statement, balance sheet, and cash flow statement each work, and how they connect. That is knowledge most people never bother to learn, and now you have it. If this video helped you, hit that like button. It genuinely helps this channel reach more students like you. Subscribe so you do not miss the next video, where we go deeper into how transactions actually get recorded. And drop a comment below with your biggest question about financial statements. I read every single one. See you in the next one.